All right, welcome to Talk Tickers. Today, we're diving into Farmland Partners, that's ticker FPI, and their Q3 2025 earnings call. Now, the stock got a little 2% bump after the call, so let's get into what the market was liking and maybe what it was a little cautious about.
Okay, so first things first, let's cut right to the chase and look at the bottom line for FPI's third quarter.
So, the big headline number, the one that really turned heads, 7 cents. That's their adjusted funds from operations, or AFFO, per share. Now, if you follow REITs, you know this is a super important metric. It's all about the cash flow. And yeah, FPI's number here was, well, it was a huge surprise.
But here's where it gets really interesting, because this quarter is a perfect example of what we call the beat versus the miss. You've got this awesome bottom line beat with that AFFO number we just saw, but at the same time, their top line revenue actually went down. And that contrast, that push and pull, is really the whole story of FPI's quarter.
And check this out. This chart really drives home just how massive that beat was. Wall Street was expecting what? Just one single penny per share? But FPI comes in and posts 7 cents. I mean, that's not just a beat. It's a blowout, a seven-fold beat on what analysts were expecting. Just a huge outperformance on the profit side of things.
Okay, so this table really lays out that split personality we were talking about. Look at that AFO line. It more than doubled compared to last year. That's incredible, right? But then you look at everything else. Total revenue, net operating income, adjusted EBITDA, they're all down, and by a lot. Double-digit drops across the board. So the big question is, how on earth do you make more profit when you're bringing in less money? Well, let's get into it.
And the answer, it turns out, is all about their strategy. It comes down to one word, really: simplification.
So here's what they've been doing. Management is basically on a mission to streamline the whole company. They sold off their brokerage business, they did this clever property swap to clean up their books, they're paying down debt, and they're buying back their own shares. It's all part of a very clear plan to focus on the core business and be way more disciplined with their finances.
And a really big piece of this puzzle was this one key transaction. Basically, they took 23 of their properties and traded them to get rid of $31 million worth of these special preferred shares. Now, what that does is it cuts down on their future payments and makes their whole financial structure a lot cleaner. And you know what? The market absolutely loved that move.
And this all feeds into the big idea here, which is de-risking. What they're doing is they're getting rid of some of those less predictable revenue sources, the lumpy stuff, to build a stronger, simpler financial base. It's that classic trade-off, right? You're giving up a little bit of growth on the top line right now for a whole lot more stability down the road.
All right, so the numbers paint a pretty clear picture. But now let's go inside the earnings call itself and hear what management's take on all this was.
So right away, the executive chairman, Paul Pittman, kind of pumped the brakes on the excitement. He basically said, look, while we're thrilled with this year, it's based on some one-time events. You can't promise them. The message there is super clear. Hey, analysts, don't just take this amazing quarter and assume it's going to happen again and again. These were special circumstances. Then, during the Q&A, analysts really started digging in. They wanted to know about the new China trade deal and how that might help the farmers who rent FPI's land. Management also dropped a really important nugget about future growth. For years, they've been able to raise rents pretty nicely, but now they're saying we should expect those rent renewals to be pretty much flat for a while.
But the CEO, Luca Fabbri, he spun that big property exchange as a major win for their long-term thesis. He pointed out that they got a value for those properties that was 56% higher than what they were worth a decade ago. He called it, quote, tangible proof of the appreciation potential in this asset class. So for him, it's all about proving that their core strategy of just owning good farmland pays off in the long run.
Okay, so that's the rundown of Q3. But what does it all mean for the future? Let's switch gears and look ahead. Here's our take on what to watch for.
And believe me, the next few months are going to be packed with action. In Q4, they're set to officially close that brokerage sale and the big property exchange. Then, come January, shareholders are getting a nice special dividend. And looking out a little further, in early 2026, the rest of those preferred shares come due, which means they'll need to have cash ready. So yeah, a lot of moving parts and potential catalysts coming up. So all of this creates a really classic bull versus bear debate for the stock. If you're a bull, you're loving the disciplined management. You're pointing to the rising AFFO guidance and how they're returning cash to shareholders. But if you're a bear, you're worried. You're looking at that shrinking revenue, you're hearing flat rent growth, and you're saying, hey, this great quarter was just a one-off. So, where do we come down on all this? After looking at both sides, we're kicking off our coverage with a market perform rating.
Look, management is doing a great job executing their plan, no doubt about it. But we think the market already knows that, and it's baked into the price. That weakness in revenue and the flat rent outlook, that's probably going to put a ceiling on the stock for the time being.
And that really leaves us with the big question as we head into the next call. Now that they're simplifying the business, getting smaller and more focused, where does the growth come from? Is there a new chapter for FPI? Or is the future of this stock all about just collecting rent, paying dividends, and waiting for the land value to slowly tick up?
And just a reminder, this is not financial advice.